Indeed, it has been the worst May since 1962. Yep, our charts go back that far, even with the triple-digit gains of yesterday. But is the worst behind us, and can stocks rebound in June? Well, let's ask Tom Lydon, ETF Trends editor, and David Dietz, President and Chief Investment Strategist at Point View Financial Services. David, you're the bear. Tom, I believe you're the bull. Build us the case for the bear. David?
Well, you know, stocks have had a great run since the worst financial crisis since the 1930s, right on up through April, and it's all predicated on being able to export our way to a fast-growing overseas economies, huge government spending, and very low interest rates. But now, guess what? We're finding out that the problems of too much debt and too little growth are just as bad overseas. And of course, the flashpoint has been Greece. And the sad thing is that despite close to $1 trillion of assistance, all the experts are saying that's not going to be enough to solve the problem. And it's so bad that even the French president talked about leaving Europe, and in Germany they said the euro was a dangerous situation. I mean, how is that going to help us export our way to further growth in corporate profits?
All right, well, very cheerful, David. Thank you for that. Let me go to our friend Tom. And I want to pick up on what David is saying and Mandy's point that the euro is a risk indicator, Tom. Can an investor right now truly believe that A, the euro is bottomed, and that B, Europe has solved its funding problems and its solvency problems and its welfare state problems? How can one confidently believe that all that is pushed back into the closet?
Well, it was nice to see China have a vote of confidence in the euro, but frankly, Larry, we don't know how the euro is going to affect the economic numbers. Seeing the economic numbers today, again, they're okay. They're not as good as most people would expect or most people would want. Americans are getting a little bit frustrated. They want the economy to move on faster. But the bottom line is the economic numbers are moving in the right direction. Earnings numbers are moving in the right direction.
Are they really moving in the right direction? I mean, just today we had some worse than expected numbers. David, would you say that maybe the economic momentum is stalling?
Absolutely. I mean, we just had a downgrade in terms of the amount of GDP growth in the first quarter. Most people think that the growth in corporate profits topped out in the first quarter, and now our biggest problem, which is residential real estate, seems to be heading downhill now that the government tax credit has expired.
But profits are booming. Come on, after-tax IRS-related profits from yesterday's GDP report are absolutely booming, Tom Lydon. I mean, to me, zero rates, very strong profits, a very steep yield curve are all positives on the scene. I recognize the euro negatives, but I don't agree with Tom. I don't agree with David, Tom. I think profits are really strong, and that's a big difference from what we saw in 2007, early 2008, is it not?
You're right, Larry, and we're not spending enough time looking at that. And again, for the month of May, seeing this huge correction, 12% domestically, 20% overseas, for investors that were looking for an opportunity to get in, now's your opportunity. And also with these technical indicators just breaking above the long-term trend lines, the 200-day moving average, that removes the emotional element. As long as you track that 200-day moving average, you remove the emotions from that investment discipline.
What are valuations looking right now? Right now, I'd like both of you to answer this, because obviously we've just had a little correction. Who knows whether we're going to have further correction? But you know, a lot of people are saying this is just a bull market correction. But nonetheless, since the March lows of last year, we're up about 60%. So, David, what do you think valuations are looking like?
Well, we're a little old-fashioned, and we like to look at dividends. And right now, the yield on the S&P 500 is flat 2%. Now, realize that historically, up to 45–50% of your total return on the market was due to dividends. That does not bode well going forward. That's not a cheap market.
Tom, where does a bull like yourself go? Where do you invest?
Well, a couple of things. Pisani and CNBC asked us to put together a bull portfolio of ETFs, and we did that. One is the Ridex RSP equal weight, so you're getting mid-cap, small-cap, as well as large-cap. Also, the Golden Dragon by PowerShares, with the biggest growth that we've seen in 3 years in China. And then another ETF that we love, which is the junk corporate bond high yield, 10% return. And again, with cash flow up 30% year over year for junk bond components. Very, very positive.
All right, gentlemen, thank you very, very much.